everyone, welcome to the Morningstar series Ask the Expert. I'm Emma Wall and I'm joined today by Kenneth Lamont, passive fund analyst for Morningstar. Hi Kenneth.
Hello Emma.
So we're here today to talk about strategic beta, in particular income strategies, which are incredibly popular, aren't they? Just how popular are these income strategies?
Well, they dominate the strategic beta landscape. You can see the extent of this if you read our latest research, our latest global guide to strategic beta. But just to summarise, they take up more than 50% of the AUM, strategic beta AUM in Europe currently. Of the top 10 most popular funds, they occupy 7 of those spaces. So they're very, very popular at the moment.
And that's no surprise, really, when you look at the dire straits we've been in the UK for people looking for yield. It's been more than 6 years since base rate was dropped to 0.5%, and both passive and active strategies that focus on income have grown in popularity over that time. Maybe we can help the end investor now by sort of outlining how they can best find an income strategy ETF. That, you know, how do they sort the wheat from the chaff?
Well, as always, when you're looking at passive and active strategies, price would be one of the big, it's one of our 5 pillars, but it's really something you should look at here. This is one of the most robust indicators that we have of future performance of any strategy. So low fees, good.
And actually in the strategic beta space, there has been some quite high charging funds, haven't there, compared to the sort of simplified ones. So it's a case of making sure you're picking the one that gives you the most bang for your buck, gives you the most return to your pocket.
Certainly, there's a significant diversity in the fees charged. You may have only 15 basis points for some strategic beta offerings, but these can run up to almost active fund fee levels. So.
And once you've done that, what's next on your checklist?
Well, as all of these funds screen on a basis of yield, and they would look at a cross-section of sort of historical yield, and select and weight their constituents based on yield. So you're looking at for a strong performance through time, really. And
is it as simple as just looking at the highest yielding fund, or should you be looking at growth of dividends as well?
No, I was going to come to this. You sort of scratch the surface a little bit, and you delve a bit deeper, and you would want to look at the growth of dividends. And many of these strategies do screen their constituents on historical growth. So firms that have not dropped, let's say, the dividends they've given over perhaps a 3 or 5 year period. So
we've got price, we've got yield, we've got growth of dividends. What's the final checklist that one should do before looking for an income strategy?
The final would be stability. We'd be looking, if you're looking at these products to produce a steady income through time, it's very sensible to check that they have done this in the past. And again, some, but not all of these funds use fund stability as one of their screening criteria.
Because as you say, it's very important, especially if you're investing in retirement where you may not have any other wage other than the income from your investments, to make sure that what you think you're investing in is actually what you're investing in, a sustainable income stream.
Absolutely, yes.
Kenneth, thank you very much.
Thank you, Emma.
This is Emma Wall from Morningstar. Thank you for watching.